Well, one very important thing is that, trade balances are not driven by tariffs. Trade balances are driven by some countries are better at producing some things, and other countries therefore would like to import those things. And in this case, China is better at producing toys, ties, T-shirts, and we produce that cheaply. And of course, we get cheap goods, and they get a lot of production. So it's not the case that someone is taking advantage of each other. So one very important myth is that this is just the way the world works, that some people are better at some things, some countries are better at some things, and therefore this is just the outcome of actually a very efficient result, namely globalization has basically allocated resources around the world to where is production done most efficiently and cheaply relative to other countries.
So are we over worried about trade then, Torsten? I mean, it's dominating the headlines every day, or are we under worried about trade?
Yeah, well, the issue here is that the second narrative that often goes around and that we hear a lot from clients when we have discussions about where markets are going is that, well, these countries that are exploiting other countries, well, is that because that they have a higher, lower tariffs, or what is exactly the situation relative to, for example, again, China relative to the US? Well, it is true that both on tariffs, China does have higher tariffs, meaning more protection than the US. It's also true that China has more non-tariff barriers to trade, meaning trade protection, which is not directly associated with tariffs, but is all other kinds of rules and regulations, restrictions on competition, restrictions on movement of labor. So another myth that also gets a lot of attention is that, well, it's not the case that as such that you have that these countries are doing things sort of good or bad. It's just the case that they do, in particular again China and several emerging markets, they do protect themselves more through tariffs, and they do also protect themselves against more monetary barriers. But if you look at US, Europe, Canada, and you have the OECD area more generally, then they actually have tariffs and non-tariff barriers that are incredibly similar. So there is very little difference in the trade systems between the Europeans and what's going on in the US and Canada relative to what you're seeing in emerging markets.
But if I read you right, something that should be considered good news could actually be skewed to look bad, and that is the current account deficit, not the trade deficit. What I mean by this is the 10-year bond is yielding, whatever it is. I mean, it's not yielding hardly anything at all, right?
Yeah, 287.
Yeah, 287. Can't get to 3% because people want to own it. But because we are a safe harbor for so much foreign capital, it screws with the current account deficit numbers. Is this a good thing or a bad thing in net?
Absolutely. This is absolutely at the center of the radar screen for markets at the moment, namely, if you look at the U.S. economy, it's basically overheating. There are signs of wages going up. There are signs of inflation moving high. That says that rates should go up. You have a treasury supply issue. There's a lot of treasuries that have to be issued to finance the fiscal tax cut that we just got earlier this year. That's also saying rates should go up. So at the same time, you have these issues in Turkey. You have these issues here with trade, which actually say that rates should be going down because exactly as you say, Brian, the U.S. is a safe haven, so the rest of the world wants to have U.S. rates. So it's a tug of war between the old school macroeconomic arguments for saying rates should go up relative to the safe haven arguments that the U.S. is the safest asset, essentially still perceived to be the safest asset in the world.